We are now live, so hello and welcome to those of you joining us just a few minutes early. My name is Charlotte. I'll be your money show host for this session. We are getting ready to begin on time with both Mike and Anastasia here in the Zoom room with me at 9:30 a.m. That's Eastern time. Thank you so much for your patience, and I hope you enjoy the show today. Welcome in to those of you just joining us. Good morning. Thanks for being here. We will be getting started on time in just a few short minutes at 9:30 a.m. Eastern Time. Thank you for your patience. Hello again, and welcome to those of you just joining us. We will be getting started in just a couple of short minutes here at 9:30 a.m. Eastern Time. Thank you. Hello, everyone, and welcome to the session. Thank you for tuning in today. I have here with me Money Show's editor-in-chief, Mike Larson, joined by Partners Group Managing Director and Chief Investment Strategist, Anastasia Amoroso. Now, to our live viewers, if you have questions throughout the session today, please type them in the live chat box. We'll do our best to have those answered towards the end of the session, time permitting. And with that all said, Mike, I will hand the mic over to you. The floor is yours.
Wonderful. Thank you, Charlotte. I'd like to extend my welcome to everyone joining us for the Money Show Investing in Alternatives Virtual Expo. If you've seen some of the materials, you know over the next 2 days on the platform, our experts are going to be covering the wide range of alts available to today's investor, from private equity and credit vehicles to digital assets, precious metals, real estate, and more. You're going to learn what they can do for your portfolio and which options our experts believe are most attractive in this market environment. And rest assured, we're also going to cover the most important economic, industry, and sector-based trends that are impacting traditional public markets too. And of course, give you some tips and strategies for your stocks, your bonds, your ETF holdings, and more. Now, as Charlotte mentioned, please remember these expos are meant to be fully interactive. Your questions are welcomed. Our experts will do their best to answer anything you throw at them. So please do use that chat box on your screen. Type them out as you listen to what our experts have to say. And moderators and myself will do the best to get those handed over to them so they can get you questions answered. That said, I do want to dive right into this fireside chat, which features one of Wall Street's leading experts on the private market space. Anastasia Amoroso has more than 2 decades of experience in a variety of roles in the industry. Currently, she serves as Chief Investment Strategist for the Private Wealth and Retirement Business Unit at Partners Group. In this role, she's responsible for providing macroeconomic, private markets, and portfolio management insights to wealth advisors and individual investors. Prior to joining Partners, she was Chief Investment Strategist at iCapital, and she's also held senior roles in investment strategy and portfolio management at JP Morgan Private Bank and Merrill Lynch. Anastasia, thank you so much for joining us here today.
Thanks, Mike. Great to be with you. And thanks everybody for joining as well.
Yeah, glad you can be on the platform. It's such an interesting time to talk about what's happening in private and public markets for that matter. I want to start with the big picture and just give you a chance to summarize for the viewers the state of affairs, how you see things in public and private markets here, and then we'll delve into some specific trends and developments.
Sure, Mike. I think if I were to use one word, I would actually say constructive. And clearly, we're going to talk about the headlines that came out overnight. About whether the peace deal is holding or not. But if I look at the state of the US economy, of the global economy, I see just a lot of constructive developments. And the way to kind of parse through that is to think about the consumer part, the corporate part, and also what is happening with CapEx. And today, when I think about the consumer, and again, we can get into the K-shaped discussion there as well. But when I think about the aggregate state of the consumer, jobs are still there, they're available. The unemployment rate is holding fairly steady. Wage growth is still rising and in some cases outpacing core inflation. And so consumers in general are still able to spend, and they're certainly doing more so than they have, let's say, this time last year. So that's kind of the first part. The second part is the corporate pillar. And look, we're on the cusp of another, what might be record-breaking earnings season. And if you look at the earnings data from last reporting season, we saw over 20% year-over-year EPS growth. We saw record profit margins. And again, when I look at the data that's expected for this earnings season, we're expected to even surpass, for example, the net profit margin, the profitability expectations for corporations. So a lot is going well there as well. And then the last thing I would say, I'm quite optimistic and encouraged, I should say, about the rebound that we see in capital expenditures globally. And, different things are fueling, I would say, this rebound in CapEx in different regions. But in the US, we do have a pickup at CapEx running at about 14% year over year annualized clip, which is really the best that we have seen in several years. Now, I will know that half of that CapEx growth is AI driven, but nevertheless, that is an important growth driver. And that also is a similar trend that's playing out in Asia, for example. If you look at the Japanese economy and the Japanese stock market, part of the reason why it's performing so well is because you do have an uptick in manufacturing momentum. And actually, the manufacturing surveys over in Japan are showing the highest levels, well, maybe on record in the last 20 years. So just a lot of optimism, I would say, on the ground in the economy. And of course, from time to time, we're going to have concerns about the price of oil or the pockets of maybe overextension in semiconductors. but I would say generally a constructive outlook for the economy, which therefore should also mean a constructive outlook for markets, including private markets.
Got it. I definitely want to talk about the energy situation and some of the recent headlines. But before we go to that, I mean, to me, AI, as you noticed, or as you mentioned, has been the big story. Our investors are asking about it. There's so many ranges of opinions from boom,
Yeah.
bubble, bust, what's going to come down the pike. So can you talk a little bit about, how powerful is the CapEx boom? Is this a long-term healthy trend that still has plenty of runway ahead of it? Or are we at that point where whether it's in terms of the money being raised in debt markets to spend and equity markets as well, is sort of a yellow flag?
Sure. There's a lot to unpack there when it comes to AI, but maybe just to pick up on the first question, is this a bubble? And it's interesting, Mike, because, as I do presentations around the country, around the world, that was the question people wanted to ask, back in the fall of last year. And then it sort of subsided this year. And I think the reason for that is the reason why not many people are asking about the bubble-like characteristics of AI is because I think we've realized AI is a massive shortcut to productivity. And we don't want to go back to the pre-ChatGPT, pre-Gemini, pre-AI era. And we want to maximize the productivity gains that we might realize. And whether it's consumers, whether it's enterprises, the adoption of AI is rising. So just to give you kind of an example of the pace of adoption, right? Let's say probably today in the US economy, depending on whether you look at consumers or enterprises, between 45 and 50% of consumers and enterprises have adopted some sort of an AI application. And, maybe that, by the way, seems low relative to China. I saw the stat the other day that 100% is the adoption rate amongst consumers and enterprises, I think, is in China. So maybe from that perspective, it seems like we're lagging behind. But let's go back and think about, 3 years in, after the advent of personal computer or after the scaling of the internet, what was the adoption rate there? It was 20%, it was 30% respectively. So AI is technology is scaling faster than anything that we've actually seen before. Now, it's one thing to scale adoption, but it's another thing to scale monetization. And there, Mike, I think that's the reason why some of the questions have subsided is because we're seeing tangible signs of monetization. For example, if you look at the hyperscalers and the cloud revenue growth that we see for those, it is rising at least 20% per year. And if you look at kind of the projections, they continue to move to the far right. If you think about the cloud revenue backlog these hyperscalers reported in the last reporting season, it's $1.5 trillion of future revenue that is yet to be recognized. So that is tangible, and that explains to investors why the hyperscalers are investing hundreds of billions of dollars into those data centers. So it's signs like that. It's let's say the memory semiconductor revenues that are scaling. It's the likes of NVIDIA, it's the data centers, it's the servers, it's so many parts of the AI ecosystem that are seeing tangible revenue growth and profitability. So I think that's why my answer is no, AI is not in a bubble. Are there pockets that need to be watched? Are there pockets of concern? Yes, absolutely. And I would be paying very close attention to some of the AI native startup valuations. There's been so much private market venture capital backed activity in the AI vertical, not surprisingly, but are all of those companies going to succeed? Probably not. So I would be cautious about some of those. And I would be, I guess, constructive but cautious about the semiconductor trade. Look,
Okay.
we do absolutely think that semiconductors, including memory chips and computers, the enabling technology. But did we get a little bit maybe overexcited about the tokenization and the token maxing? And did we maybe project that too far out into future revenue growth? Perhaps. So I think the process that the market is going through now, sort of reassessing the linear nature of semiconductor revenues and semiconductor performance, I think it's the right thing to do. So I would be paying close attention to that.
Okay. I know that you and your team there at Partners put together a fantastic chart book, a lot of insights and graphics on what's going on there. And my partner Charlotte's going to share a link with people who are watching this. One of the things you talked about was the productivity boom scenario there.
Yeah.
You've covered some of that here, and I'm curious as to what it means for policy. There's been this sort of evolving discussion that, on one hand, AI and all the things associated with it, the demand on power, it's driving up electricity costs and so on and so forth, could be inflationary. On the other side, it's, we're going to see more productivity in corporate America. It's going to ultimately be something that can allow the Fed to sort of stand pat and see how this thing evolves. Where do you come down on the policy implications of the AI boom?
Yeah, so let's take that in several parts. Let's talk about the productivity and why we've upgraded the productivity scenario, and then yes, what this means for policy going forward. First of all, again, we're seeing tangible signs of productivity increases reported by companies. We also are seeing that within our own portfolio companies because 90% plus of our companies have a suite of AI initiatives associated with that. So 20, 30, 40% productivity growth is common. And so that's why we've been increasingly gaining confidence in the productivity gains accruing across the economy. And if you look at US productivity growth, just since the launch of ChatGPT, pre-COVID, productivity growth used to run at about 1% year over year. Since the launch of ChatGPT, that productivity growth has stepped up to 2% year over year growth. So that's double in a short period of time. And so we think, given sort of this moderate AI adoption scenario, we could permanently see a shift in productivity from this 1.5% or so to closer to 2.5%. So that lifts the GDP growth potential then from 2.5% to probably 3.5%. And that has a lot of implications for investors. Now, I will say, by the way, Mike, as we think about our 5-year scenarios, this is a 20% probability of that scenario. We have a 50% probability of just status quo base case, which is still constructive. But in the event that we do actually get to that productivity boom scenario, 3.5% GDP growth, more business creation, more revenue to go around, more profitability to go around. But here's where we get into the policy implication. Under that same scenario, we're actually modeling inflation around 2%. We're actually modeling interest rates somewhere around current levels. And the reason for that is that I tend to share new Fed Chair Kevin Moore's sentiment is that technology historically has been deflationary. And if you think about what AI does, it could also can be deflationary. So let me map that out a couple of different ways. So if you look at the S&P 500 companies for the last 3 or 4 years, and if you look at the specific metric, which is revenue per employee, revenue per employee for the S&P 500 company went from something like $350,000 per employee to now $650,000 per employee. And so maybe that's by keeping the headcount steady. Maybe that's because of the productivity boosting measures and the fact that engineers at Meta and others are a lot more productive using AI. But bottom line is the payroll expenses for these corporations are actually staying steady. So there's not quite as much inflation, wage inflation to pass through to, let's say, the end consumer. So that is deflationary. And the fact that companies can do more with same or less amount of resources, again, that's the boost to productivity, profitability, and that alleviates a lot of different inflation pressures. So that's one side of it. The other side of it is that I wouldn't call the labor market a risk, but I think it is going through a reallocation process or a rebalancing process. And certain jobs, certain industries are seeing job growth. Others are seeing job loss because of AI. And today, about 1% of the US labor force is in a job that has 100% AI automation potential. Now, that doesn't sound like much because it's 1%, but a quarter of the US labor force is in a job where a lot of tasks have 90% plus AI automation potential. So I do worry about what happens to that cohort, which is a quarter of the US labor force, if more and more of those tasks get automated. So I think that's another deflationary undercurrent that we have to watch for. And again, that's why under that AI productivity boom scenario, we actually think inflation can return to that 2% goal.
Got
Gonna
it. Thank you
raise
so
my
much for
hands
that.
to hopefully turn some lights back on here.
Got it. Well, let me pivot to the other big topic that's on everybody's mind, especially today, and that's energy prices. Obviously, we've seen, at the peak of the latest Middle East conflict, we're up around 110, almost $120 a barrel in terms of global oil prices. They've come down quite a bit. Now we're rising as there's some question as to whether the ceasefire will hold. Talk a little bit about, a couple of different scenarios. Let's say we sort of muddle through with the ceasefire process. What does that mean for policy and markets? And let's say if we get back in a situation where things are a little more intense in the Middle East, how does that impact your outlook and for, again, private and public markets?
Sure. Yeah, let's take those two scenarios. First of all, what if the memorandum of understanding doesn't hold? Clearly we have seen oil prices spike already, but I would say that even under that scenario, the situation is manageable. And the reason for that, as we've argued back in March of this year, is fortunately the oil market went into this scenario with buffers. And one interesting thing that we found in our data is that even though we've had the outage in the Strait of Hormuz for 3 or 4 months, we've not actually drawn down our inventories as much as we could have. So the bulk of the adjustment to higher oil prices or to lower supply came from lower demand. And a lot of that actually came out of Asia. Some of it came out of Europe. So as a result, we actually do still have substantial inventory buffers that are available. What also happened is some of the strategic petroleum reserves from the government inventories, those have been drawn down, but a lot of the private inventories have actually been kept in place. So fortunately, we do have the buffers. Fortunately, we also do have the rerouting mechanisms. And this is one of my longer term views is that even if the strait opens up fully tomorrow, the next day, the day after that, the memory is not going to be short on this one. As investors, as the countries in the Middle East, we're not going to forget very quickly what happens when the strait shuts down. So I think it is a permanent shift in how we're going to get oil out of that oil producing region of the Middle East. So whether it's the East-West pipeline that runs through Saudi Arabia, whether it's the pipeline that runs from UAE through Oman, UAE, for example, is I think building a third pipeline to try to surpass or circumvent the Strait of Hormuz. So fortunately, in this particular scenario, we have used those rerouting mechanisms. We can go back to using those and run there at max capacity. And longer term, I think that's actually how oil gets out of that region. So bottom line is, yes, oil prices may move higher, but we do have inventories to prevent the physical shortages. And when I model all of that, and by the way, that's in our chart book, and you can find a slide on that. When I model all of that, what does this mean for GDP growth? Well, we would shave off something like 30 to 50 basis points from GDP growth in the United States. Look, that's manageable, right? As long as the remaining economy is functioning. And the reality today is whether it's the US economy or the Chinese economies globally are a lot less oil intensive than they used to be. 70% lower oil intensity is what we have today relative to the 70s. So as long as under that scenario of higher oil prices, prolonged uncertainty in the Middle East, the Fed doesn't hike interest rates significantly, as long as that holds, that we think the situation can actually be manageable. Now,
Oh,
just one last thought. That was
please.
one scenario that I thought was we wanted to spend the most time on. But under the other scenario, and I actually said this yesterday, of course, before the news of this morning. But under the other scenario, the fact that we can pencil out the drag from higher oil prices actually boosts a lot of animal spirits, consumer confidence, business confidence, you name it. And in private markets in particular, we've had solid economy, but we have seen a slowdown in transaction activity, for example. There's not been as much deployment of capital in the first quarter, second quarter of this year. We have seen some slowdown in exit activity as well. But to the extent that the economy perseveres, the MOU holds, we would expect that confidence to return and that deal making activity to pick up in the back half of the year.
Got it. Just a reminder, viewers, we're a little more than halfway through our session time. Please do feel free to type any questions you have in the chat window. We'll do our best to get to them in the time we have and make sure they're answered for you. I do want to pivot to some of the kind of actionable themes and more ground level type things versus macro for the rest of our conversation. And that would include some of the things you're seeing in private credit and private equity. I know you've talked about a new normal in private credit markets and why credit selection is more important. Can you please talk about what that means and what the implication is for somebody who's looking to invest in the space?
Yeah, private credit, Mike, you probably heard this for many people say this for years. It's the golden age of private credit. It's the golden age of private credit. And look, it was because you could easily allocate to, many deals, earn the coupon, and, rates were somewhat elevated and defaults were low and all of that was fine. Well, today, what I would say is from a macro perspective, I don't actually have a whole lot of concerns about private credit, and I'll explain that in just a little bit. But from the AI disruption perspective, we certainly do have some concerns. And, so the premise here is that we really have to shift the mindset from the golden age of all private credit to this being the golden age of private credit selection. And the companies that you want to select going forward, you have to think of them with AI first mindset. Are the companies that you're investing in, are they AI proof? Are they future proof? Or are their business models going to shift substantially over the investment time horizon? So that's why for us, for example, at Partners Group, just like we invest in private equity with that AI first mindset, we also want to do the same thing in our private credit as well. The reality is many companies, many credits that were issued, let's say in 2021 for some of the software companies, some of those business models may shift and some of them may shift very quickly. So that's why we talk about this bifurcation and the need for private credit selection. I'll come back to that point maybe just a little bit, but I do want to say from a macro perspective, though, I know there's been a lot of headlines about private credit. But actually, when you think about private credit loan coverage ratios, they have improved. They're not as high as they were before 2022, but they certainly have improved. If you think about the equity cushions in a lot of the private credit transactions, they've also been moving higher and higher and higher because less leverage has been deployed in the private equity industry. If you think about just the revenue trajectory, the earnings trajectory of some of these middle market private credit backed loans, that trajectory is fine. It's not, revenue growth, earnings growth is not doing as well as the Max 7, but it's still running at 7 or 8%, give or take. So from a macro perspective, I don't have a lot of concerns about private credit, but yes, selecting credits with the AI first mindset is really important. Maybe the last thing I will say on that is, I mentioned software loans and, on the surface, right, software loans represent about 20% of private credit, which seems substantial, which is why some have called for significantly higher default rates in the space. But actually, it's not that all software is debt, and certainly not all debt at once, right? So we have to think of it as, different categories of software. For example, you can have a horizontal software company that may cater to all industries, does not necessarily have a proprietary data set, and may actually be easily disrupted, versus a vertical software company that does have domain expertise, whether it's in healthcare or industrials or supply chain, has proprietary data, and because of that, has this moat around it. So if you think about the public markets, and if you look at some of the, the popular software ETF, IGV, 70% of that is actually in the horizontal or application software companies. But when you look at private markets, you have a lot more exposure to vertical software. So the true software at risk in private credit, that percent is probably not 20%, but it's closer to 7%.
Got it.
But these are the kind of nuances clearly that we need to have.
Sure.
With investing going forward.
I haven't seen the question pop up in the chat, but I know I've been asked it at a couple of conferences recently. And some of our investors hold things that are sort of private credit adjacent or public vehicles for investing in the space, BDCs. They may even have broad financial stocks, ETFs, things that are have seen a little bit of a pullback related to some of those concerns. What are your thoughts on that? Is that what would I guess you answer a question if somebody asked, well, if I own these things, how do you see the macro environment shaking out, and what does it mean for them?
Yeah, I mean, I think if you look at the BDCs, they've certainly been going through a period of volatility, but as those prices, publicly traded prices, have pulled back, but actually, if you look at the underlying kind of credit spreads and the credit quality of this BDCs, you haven't seen a whole lot of credit spread widening for those. Which kind of tells me that maybe there's still some optimism about the underlying credits that these BDCs invested. And so as a result, you have this disconnect between the net asset value of the underlying loans versus the publicly traded price of the BDC. Assuming our macro scenario plays out and assuming some of these, kind of the credit bifurcation doesn't play out now, but let's say it's 5 years from now, I actually see potentially an opportunity there as the publicly traded BDC prices have pulled back quite substantially.
Got it. I know one of the other things, and again, we probably have about 5 minutes left. One of the other trends you've talked about is the infrastructure, the ways people can invest in infrastructure, and how that's been sort of a theme worth playing or considering. Talk a little about the demand for that asset class and some of the ways people can participate if your outlook does pan out there.
Sure. I mean, we have seen significant demand for infrastructure for clients, and I can say that by looking at industry data. Infrastructure fundraising has been incredibly strong. I could also see that in our own fundraising efforts, and our infrastructure business has been very well placed to capture some of that demand. Look, I think the reason why infrastructure is resonating so well with clients is probably twofold. First of all, as we've learned in 2022, having stocks and bonds does not give you the diversification that you may want. In 2022, the stocks and bond portfolio was down about 17%. And even if you have large caps or small caps or high yield, look, it is still a high degree of correlation. So if you're looking for a true uncorrelated asset or low correlated asset to the rest of the portfolio, there's only so many things that you could add, but infrastructure is squarely one of those things. So depending on the type of infrastructure or the type of asset you're benchmarking it to, but probably 0.3 is the correlation that you have to the global 60/40 portfolio. So from a portfolio construction standpoint, infrastructure has resonated very well. And then the other, well, maybe a couple of other reasons. The second one is, look, it's been a while since inflation has truly been at 2%. And sure, we can slice and dice in many different ways, but I think a lot of investors still worry, what if inflation is persistent? What if inflation continues, actually accelerates from here? And so infrastructure is one of those assets that also gives you that inflation hedge, because a lot of our cash flows in our infrastructure business have inflation pass-throughs, escalators, I should say, whether it's data centers, whether it's another infrastructure asset. So that allows you to benefit from the potential increase there. And, another interesting tidbit is, as we've worried, or investors worried about the rising price of oil, what this means for the financials of portfolio companies. Within infrastructure, 85% of our companies have the ability to pass through the higher cost of commodities to their customers. So it sort of goes both ways. The revenues may be adjusted higher, and also the cost gets passed through. And then the last point, and I'll make this quick, is that, look, infrastructure is where a lot of secular growth is today.
Yeah.
Whether it's AI and the need to invest in data centers, the fiber connectivity that is essential to operating those data centers, whether it's the energy that needs to be built out to power those data centers, infrastructure does all of that. So a clear correlation to investing in AI. And also, I wanted to stress that what happened in the Strait of Hormuz today, again, has long-term implications. And prioritizing energy sources that are local, that are diversified, maybe not fossil fuel based, that's a huge trend. And I think that's here to stay. And again, we're investing behind it. We have been and certainly will continue to do so as a result of the conflict.
Wonderful. Well, Anastasia, I really do appreciate taking some time out here to chat with me and viewers. I hope you got a lot out of this session. Again, if you have any questions, you can certainly send them to us afterwards. We'll try and get them answered for you. And we'll look forward to maybe seeing you at another virtual or live event down the road.
Thanks so much. Thanks, everybody. Great to see
Wonderful.
you.
Take care.
Take care.
Thank you both. And to everyone watching, be sure to stay tuned as we have a lot more in store for you in this Money Show Virtual Expo.